Live from Bloomberg's world headquarters in New York City, we're tracking the key players, the major moves, and the capital flows shaping global markets. This is Bloomberg Deals.
Welcome to the first ever episode of Bloomberg Deals, the only show dedicated to the corporate action reshaping markets. Let's get to the big deals this week. Ready for launch, Elon Musk is combining SpaceX and xAI in a deal that values the enlarged entity at $1.25 trillion. Texas Instruments reaches an agreement to buy Silicon Labs for about $7.5 billion, deepening TI's ties to chips. And in just a moment, we're going to be speaking with Brookfield CEO Bruce Flatt as we learn that Flatt will be stepping down as the head of the firm's $1 trillion asset management business, opening up a new chapter for Brookfield. But first, let's get to the reporters behind the headlines for today's big deals. And we're going to start with Texas Instruments. I'm so happy to say that joining me on the inaugural show is Bloomberg Deals reporters Michelle Davis and Ryan Gould. Thank you both so much for joining.
Thanks for having us.
Michelle, I want to start with you on this Texas Instruments story. Buying another chip maker, what do we know?
So this is TI's biggest deal in 15 years, and it comes as we're seeing a lot of consolidation in the chip industry, driven by the AI boom. And now TI isn't necessarily an AI specialist. They do what's called analog chips. And what they're getting with Silicon Labs is a chip that specializes in like wireless solutions. So think Bluetooth for industrials. It's higher growth, and they want that because it's going to diversify their portfolio.
I mean, you make a good point. Not all the chips are same. This is analog. In the AI world, I mean, it's kind of this weird drama that's been unfolding over the past couple of days of how committed is OpenAI and NVIDIA, that partnership. It seems like NVIDIA might be somewhat committed.
Exactly. The latest headline overnight in Bloomberg is that NVIDIA is going to be investing $20 billion in OpenAI. That's NVIDIA's biggest investment in an AI startup ever. And it does kind of add some context to some of these headlines we saw over the weekend about whether there was tension and if the relationship was breaking down. For now, it seems like both companies are publicly saying that they are committed to each other. And, you know, we're just going to be following along to see who else jumps in and how much more OpenAI invests.
Yeah,
and NVIDIA invests.
Maybe it's not a marriage. Maybe it's like a complicated situationship sort of thing. Ryan, I know you've been tracking a different deal very closely. That's the SpaceX xAI merger. We got confirmation of that deal this week after earlier reporting on it. Why is Elon Musk combining and creating this behemoth?
Talk about complex mergers. That's an interesting one. I mean, this is the biggest, creating one of the biggest private companies in the world, $1.25 trillion in value. This is all about Elon's idea that his companies are going to converge as one, maybe in the longer term, potentially putting Tesla as the sort of third leg of the stool. But this is about having data centers in space. His idea, his view is that the cheapest way to power data centers that we currently have sprawling across Virginia and other places in the United States is to actually take that into orbit. And that will create a really, really cheap way to get inference to power those AI tools.
When people talk about data centers on the moon, like my mind melts, because I feel like the feat of even getting someone to land on the moon is an incredible thing in its own right. Does this just end with Elon Musk putting his entire empire together? Like, why not lump in Tesla to this merger too?
I mean, we've definitely reported that that has been at least discussed. I mean, whether that happens remains to be seen. But what I would say, complicating some of that, is obviously Tesla is a very, very large public company. It's now interesting that SpaceX combined with xAI is now almost rivaling Tesla's market cap. To give you a sense as to how big that could be, as we think about mergers and machinations behind the scenes, it's much easier as a public company to think of a public company merger versus a private one.
By the way, I know Elon Musk has those targets he needs to hit in order to be paid $1 trillion. Like, maybe this is a great way to do it. Just make your company even bigger on that front. Thank you both so much for joining. I know you're going to be joining throughout the hour, so this is only a goodbye for now. That's Bloomberg Deals reporter Michelle Davis and Ryan Gould. Bloomberg's Scarlett Fu is also going to be with us throughout the hour, and she's here now to show us some of the headlines, the data rather, behind the headlines. Scarlett, I know you're looking at SpaceX and xAI this day.
I want to get to how we got to that $1.25 trillion valuation. So let's look at SpaceX's valuation over time. We start in 2017 at about $21 billion, which really did hold for a while. In October 2020, it did move up, but as you can see, the valuation held below $100 billion until 2021. In 2024, SpaceX and its investors agreed to buy a large chunk of its common shares and secured a valuation of about $350 billion. For the last few months, we've been reporting SpaceX was set to go public with their share sale at a valuation of about $800 billion. With this latest xAI tie-up, SpaceX is now valued at $1 trillion. Let's show you the same for XAI. In May 2024, its Series C funding round with investors got it a $24 billion valuation. From the end of that year through 2025, XAI was in all kinds of talks to raise funding at rising valuations. Last week, we reported the latest private funding round implied valuation of $230 billion, which then, of course, increased to $250 billion with that SpaceX deal. So, Danny, these are big, big numbers, even for Elon Musk, but that's just the way he likes it. And by the way, shout out to Bloomberg Tech co-host Ed Ludlow, who broke this story.
Absolutely. Great work from Ed and the team. I think he would have liked those big numbers better if it was $420 billion. Just have a feeling on that. Scarlett, thank you so much. And we're going to go to another big deal that we are watching today. Santander has agreed to acquire Webster. It's a $12 billion deal. It's the largest ever takeover of a U.S. lender by a continental European bank. Earlier today, Santander Executive Chair Anna Botín spoke with Bloomberg about her thinking on that deal.
They have 80% commercial business. We have mostly consumer. Together, we're going to take the Santander US, now with the corporate bank, also to 18% return on tangible equity. That is best-in-class profitability by 2028 among the top banks in the United States. Again, US has always been a co-market. This is a bolt-on but strategically important acquisition, because it drives us to our ultimate goal, which is to be one of the most profitable banks in each geography.
For more on this big U.S. bet for Spain's largest banks, I'm joined now by Bloomberg M&A editor Matt Monks. Matt, first of all, thanks for joining on the first show.
Hey, thanks for having me.
It wouldn't have been a Deals debut without you. I mean, listen, there's been a lot of regional bank mergers here in the U.S. This certainly feels very different.
So I've been covering regional banks in one capacity or another for about 15 years. That whole time, people have said there's going to be a consolidation wave. Well, we're finally in it right now. This is Exhibit A. In a lot of ways, Santander is kind of the only European bank that's left in the United States, and they're going big. They're spending $12 billion for this great franchise in the Northeast. It kind of fits them like a puzzle piece. They're getting a bunch of deposits to fund their auto lending business. There's going to be ample cost synergies. And what I think they're trying to do here is, before the chessboard kind of gets narrow with all these deals happening, they're getting out front and really getting a nice big ripe fruit.
All right, Matt, thank you so much for joining us on that. That is, of course, Matt Monks from our Deals team. Coming up, a conversation that you do not want to miss. It's Brookfield CEO Bruce Flatt. The stocks for the company and its asset management arm are both higher in today's session after reporting earnings. We're going to talk to the head of one of the world's biggest asset and private capital managers. And later this hour, our very own Deals Show Investor Committee. We're going to be featuring Andy Nussbaum, who's the main legal advisor for Warner Brothers Discovery. Conversations you don't want to miss. Stay with us on Bloomberg Deals. One of the giants of deal-making is Brookfield, and its CEO Bruce Flatt is an industry titan in his very own right. This morning, the company announced that Flatt will be stepping down from his post leading the company's $1 trillion asset management business. He, of course, will stay on as the chair and as well as CEO of the parent company. I'm pleased to say that Bruce Flatt joins us now for the big picture, an elevated look at the strategies and trends shaping corporate action. Bruce, thank you so much for joining. We're so thrilled to have you as our inaugural guest.
Thank you for having me as your first customer.
I was going to say, there's no one else we'd want to kick things off with. And what a way to kick things off with this announcement that you're handing, at least for the asset management business, the reins over to Connor Teskey. I have to say, in a lot of your industry, not only are there issues with succession plannings, rarely do they lay out such a clear path. Why do this and why now?
So our business is about running great businesses. What we do is we buy into companies, we help management teams, we build them. And therefore, we're very determined ourselves about making sure we have the best succession, the best run business on the planet. So we've been at this for 15, 20 years. We've been at it with Connor for the last 4, very methodically, and all the other team across the board. And it's just the natural time, and it's really great to have young, new energy in the business, and I can be the chair and help them out as the chairman of the parent, or CEO of the parent company.
I'm going to say, how do you see your role evolving with this?
Kind of the same thing I do today. I help with strategy. I help the team when they need me to do something. I help with clients, and that's what I've done for the last 5-10 years, and that's what I'll be doing in the future.
So does this mean the timeline speeds up for Connor to take some other of your roles for Brookfield Corp CEO?
You know, so far, right now, enough. Brookfield Asset Management's enough. Sure. And we've got a big insurance business. We're building a big investment business out in Brookfield Corp. So we've got lots going on up top. And frankly, giving up one job is helpful to make sure that we can focus on other things.
I'd love to get your philosophy on talent more broadly, because clearly it's something that's near and dear to you as a leader. Of this industry leader. There is this moment right now, we've heard from other financial services companies like Goldman that growth is going to be slowing in talent hiring because of things like AI. Do you see the same thing ahead?
You know, I don't know, maybe we're different because we're backbone real asset investors, and we've never had a better time. We keep raising more money, we keep deploying it, we're earning good returns, things are great, and the business is accelerating. So, and even our credit, it's asset-backed finance credit. It's not what you see in the news today. And therefore, our business keeps growing. We keep adding people. We keep adding countries. We keep adding clients. It's pretty good. And but we're always focused. Talent, people, especially in a business like ours, but especially in every business, people's everything. And it's really, really important to focus on it. It's the easiest thing to forget about. And one should never forget about your people.
So at the same time, you mentioned it, just the real asset business that you have and this really big bet on AI infrastructure that's been evolving at Brookfield. Everything from mega deals with the hyperscalers to creating your own cloud company. There's a lot of really interesting work you're doing. If I could borrow a phrase and kind of bastardize it from Alphabet Sundar Pichai, what is the risk right now? Is it under or over investing?
So if you're in the real asset space in the private markets, it's very difficult to entitle land. It's very difficult to get power. It's very difficult to build because you can't get people to build, and therefore the investment is tough to do, and that's why there's the returns in it are excellent because people need skills to be able to do it. Now, what most people focus on is the public markets. There's a few securities which everyone wants to own, and therefore multiples go higher. But in the private markets, it's very different, and there is an underinvestment in what's going on in private markets because everyone's looking for additional AI cloud capacity, and it's very tough to build. Easy sites have been built or committed. The hard sites, now the hard work starts. And in particular, we need power. And as you know, we have a huge power business, and that's the bottleneck in artificial intelligence for the next 10 years.
I definitely want to talk with that because you've been doing some really interesting stuff there. But I do wonder just on the public market side of things, again, the fear is less about the infrastructure. It's more these hyperscalers are spending so much and maybe they don't have the revenue to back it up. And maybe that trickles down into infrastructure. Do you see any red flags, or do you think public markets are misplaced when you see some of those nerves around this?
First, when we build out infrastructure, we're generally leasing them for 10, 20, 30 years to governments or large-scale technology companies, and we just have long-term contracts. This is just a leasing business, but we're building things for them that are super critical, and only we and a few others can build them. So we're providing that backbone infrastructure, and they need more of this, and they need it at scale. And they need it in the United States today, but it's now going global in all countries in the world for various reasons. We don't have time to get into all of them here, but for various reasons, it's accelerating all over the world.
So I say, just to answer that question, it sounds like the risk is indeed underinvesting, that maybe we're not doing enough.
We are not doing enough in the private markets because it's tough to do. And that's where we are, and that's where we focus on, because it's like, really, it's not, we could do way more with the amount of money we have. It's the technical capabilities to bring on power, data centers, artificial intelligence infrastructure, and everything that's around it. That's where the bottlenecks are.
Well, first of all, on the power side of things, I know in 2023 you did a deal with Westinghouse, a nuclear energy company, which, by the way, incredible foresight to see just the immense need that we would need for that. And then late last year, we also learned that the U.S. government is doing a partnership, too. How has that partnership evolved? How much has the U.S. government, for example, been involved so far since that was announced?
So we had a discussion with the U.S. government to ensure that we could bring power on America, and we couldn't do it ourselves. We can't build all nuclear plants in the country. We're not big enough for that. We needed their help. And the Department of Commerce and the president saw fit that they would support us to build out the industry. And we need to build the whole supply chain out, because you can't just build one plant. We're going to build now 8-10 plants for them, and we're going to build 8-10 more plants for others, and it's going to build a whole supply chain out in America for nuclear. And this is very, very important, because it's bringing on power, it's bringing baseload power, it's bringing on power that's much needed in America. And we're going to double the grid in the next 20 years. And this is super critical because it's baseload capacity, and it's very, very important to the United States.
Yeah, a lot of your infrastructure is really important to the United States. Have you had talks with the U.S. government in other aspects about striking more partnerships?
You know, look, I would say they're very commercial in what they do. Where it makes sense and where business entrepreneurs can put money to work, they're very supportive. And they were very good with us, and we're going to build out. We're going to recreate an industry and create enormous number of jobs in America because of what they did.
Have you felt any more friction because of your Canadian roots or your cross-border type of business? There had been this fear, and we saw it very present at Davos, that it's a more insular United States, and maybe foreign powers. And Mark Carney's speech, who I know you know very well, talked about the need of the middling nations to come together. Do you feel that flow through?
Yeah, so 60% of our assets are in the United States. We're headquartered in the U.S. We have a huge business here. This is super, United States, super critical to us, as is every country. Remember, what we do is we build local infrastructure in countries, and we sell goods and services to individuals or companies. That's it. We don't move over the borders. We just build out and sell in the country. So we pick countries very wisely. We go to them and we build out in those countries. So we're friends with every country in the world, and we try to be great citizens. We try to do well for the country. We always try to be on the side of doing the right thing for the country, never get cross-thread with any. And build out infrastructure in the country. And what we're doing is, as you noted, super important for the backbone of the global economy. That's all we do. We either lend to or we put equity into the backbone of the global economy, and that's what these countries need, including the United States.
I heard from someone that this administration, someone said this recently to me, is just like much more willing to pick up the phone, is much more willing to listen. Is it just much easier to get things done in this country right now?
Yes. Department of Commerce, like our transaction was done with Department of Energy and specifically Department of Commerce, Howard Lutnick, and they were very transactional, and they focused on the right things, and we got a transaction done.
Late last year, you announced that you were going to be buying the rest of Oaktree, a company that you had also long had a partnership with beginning in 2019. How is that combination going to evolve as you work through it? Does the Oaktree brand get blended into Brookfield? Does it remain its own entity? How are you thinking about this?
So we have two, I'm going to say this as, we have two amazing brands. Brookfield's an incredible brand, but Oaktree's an amazing brand as well, and we plan on keeping both. Behind the scenes, some of the things that we do will be, we'll join them together and we'll do things to get cost synergies and benefits and all those kind of things. But the two brands are unbelievably valuable in our opinion, and they're going to stay. And for opportunistic credit investing, which today is super important, or more important this week than it was last week, the Oaktree brand is an incredible franchise, and we're going to keep that, and it's really important to us.
Just on that note, because you mentioned this at the start of the conversation, that there does seem to be a little bit of nerviness around credit markets. I know in your 2026 outlook, you and the team had written, credit markets are rewarding those with underwriting standards focused on asset quality. I say that kind of implies that maybe there are others who aren't focused on quality. Is there a real divergence going on?
I don't comment on any other group's business, but what I would say is our business is focused on asset-backed finance, opportunistic credit, and lending to things we understand, lending to the real economy. And therefore, we have very little exposure to the types of things that are going on today. And that may be fortuitous. I'd say in our opportunistic business, it creates a big opportunity, because then when things sell off, often they go way too far, and therefore opportunity comes about. So
are you calling up your team saying, hey, look at what happened this week?
Yes.
There might be something there?
Yes. We're very focused.
I was going to say, because you're not that exposed to software, would this be an opportunity maybe to get in there a little bit more?
We're very underexposed. to software. We're a real asset business, but in our private equity, our opportunistic strategies for credit, look at industries when they sell off and when there is value to be had. And I suspect somewhere in this cycle of software, there's going to be some amazing value to be made.
There feels to be like a lot of reckonings happening in this market. You've outlined a lot of changes, be it deglobalization, otherwise some of what you're doing in infrastructure. Is this a moment of a market reset?
Look, I think the world, the thing I'd start off by saying is, everyone gets excited about day-to-day changes in the markets. They listen to your show and then go and buy or sell. But 20 years from now, we will look back and the valuations will be ridiculously low for great companies and businesses. And that's what people should really be focused on. Focused on the long term, focus on buying great companies and businesses, stick with them, don't sell, and just stay the course. And that's been our story for a long period of time, and that's what it's going to continue to be.
Bruce, what a perfect note to end it on. Thank you so much for joining today. We really appreciate your time.
Thanks, Danny.
And that, of course, is Bruce Flatt, the CEO of Brookfield. And now we have some breaking news crossing the terminal on, as fate would have it, that SpaceX deal. Scarlett.
That's right, Danny. Bloomberg has learned that SpaceX held meetings with banks from outside the U.S. for its IPO. This is according to people familiar with the matter. These are reportedly for junior roles in that SpaceX IPO. It took place before the announcement this week that SpaceX is combining with xAI. More Bloomberg deals coming up right after this.
We're about halfway through the trading day in New York. I'm Norma Linda. Let's take a look at our midday movers. First up, AMD is tumbling for double-digit losses after the company's sales forecast underwhelmed investors, a sign that the chipmaker is not making the AI inroads initially anticipated. AMD's CEO Lisa Su said she predicts that the company's AI revenue will reach the tens of billions of dollars in 2027. Also, Sandisk shares are plunging as well. The digital storage firm has been on a wicked rally this year, with shares surging more than 150%. Investors had been trading on optimism that the company will benefit from high demand for memory products. And finally, Eli Lilly is soaring after the drug maker developed an upbeat sales forecast for 2026, a stark contrast to the disappointing outlook its competitor Novo Nordisk delivered just yesterday. Eli Lilly said it expects sales to grow as much as 27% this year. Those are your midday movers. I'm Norma Linda.
Live from Bloomberg's world headquarters in New York City, we're tracking the key players, the major moves, and the capital flows shaping global markets. This is Bloomberg Deals.
Welcome back to Bloomberg Deals. I'm Danny Berger. As the bidding for Warner Brothers Discovery drags on, analysts and executives are weighing in. Here's what they've told us.
Warner Brothers Discovery, I think it's just a fantastic asset.
I think it could be a global consolidation vehicle.
All three of the bidders, remember there was Comcast in there to begin with, have overlaps with Warner Brothers.
I don't want to be in this bidding war stuff for assets with tons of debt in a very difficult business right now. And I think Netflix is the play, and that's one of our top holdings.
They're not the only ones looking at it, and they're certainly the only one who's looking at it just piecemeal and trying to take the best bits and not the rest of it.
I think there's a hidden gem in this deal, which is the maturity of the Warner Brothers ad force.
I do think Paramount is going to have to up their bid to be competitive here.
There's likely to be more synergies from a Netflix Warner Brothers combination.
Let's go straight to Scarlett to break down the latest. Hey, Scar.
Hey, Danny. So here are the key numbers, what you need to know. Paramount Skydance bidding $30 a share in cash, which works out to an enterprise value of over $108 billion. What is key here, Paramount wants to buy the whole company, including the slow-growing cable TV networks. Meanwhile, Netflix is offering $27.75 a share. This was originally a mix of cash and stock, but is now all cash. When you include the debt, the enterprise value is $82.7 billion, less than Paramount Skydance's bid. However, Netflix is only looking to buy the streaming and studios business, leaving Warner to spin off its networks business as it had long planned. Now, Warner Brothers has agreed to Netflix's term and made clear that this is its preferred buyer. Yesterday, Netflix's co-CEO Ted Sarandos spoke before the Senate Antitrust Subcommittee to defend their agreed-upon deal.
Netflix and Warner Brothers both have streaming services, but they are very complementary. In fact, 80% of HBO Max subscribers also subscribe to Netflix. We will give consumers more content for less. This deal keeps one of the most iconic Hollywood studios healthy and competitive. Warner and Netflix together will create value for consumers, more opportunities for the creative community, and more American jobs.
Paramount CEO David Ellison turned down an invitation to testify at that same hearing, saying that he didn't think it would be useful because Warner Brothers had rejected their multiple offers. But Ellison did write to Senator Cory Booker, quote, "Down the road, if Paramount is fortunate enough to be in a position to purchase Warner Brothers, should the Netflix proposal be blocked, abandoned, or otherwise terminated, let me assure you our company would be willing to testify at an antitrust subcommittee hearing to examine that transaction." And that's the latest, Annie.
Scarlett, thank you very much for that excellent roundup of the latest on Warner Brothers discovery. And that brings us to this week's Investor Committee, where we take you into the boardroom debates in real time. Joining us now is Andy Nussbaum, co-chair of the Executive Committee at Wachtell Lipton. He is the main legal advisor to Warner Brothers. Also, Mark Boidman, he's the head of media and entertainment and partners at Sullivan Partners. And of course, Bloomberg Deals media reporter specializing in media, I should say, Michelle Davis. Thank you all so much for joining today. Andy, I'd love to kick it off with you in a very simple and perhaps complicated answer. Why is Netflix the preferred partner for this deal?
The Netflix transaction is the result of a very extensive process that this board really undertook in 2022 after we acquired Warner Media to get the value out of those assets, to delever the company, to make the operations more effective and robust, and then looked at separating the businesses. And then it turned out not only did we have the possibility to separate the two businesses, but also a lot of people were interested in buying one or the other or both. And so as a result of a very large public process, very robust, competitive, the Netflix transaction came out on top, and we do believe that that is by far the superior transaction for our shareholders.
Mark, let me bring you in on this because you are a veteran of this industry. You have long worked with media companies, tracked media deals. What are the sort of considerations one should have, and what is a very large transaction?
Sure, Danny. It all comes down to speed, certainty, and what Netflix does offer is speed and certainty. They're moving ahead. They have the cash. They have the balance sheet. I think what you see is other bidders who don't provide that certainty. And shareholders, at the end of the day, Wall Street loves certainty.
And Andy, we know that Warner Brothers shareholders are going to get a chance to vote on this deal in the coming weeks. What have you been hearing from shareholders so far about how they're viewing the Netflix deal? Obviously, Paramount's also trying to break this deal up.
So the Netflix deal, which is really two deals, the $27.75 in cash that our shareholders would receive when that transaction closes, plus the spun-off Discovery Global a linear network business as a new public company, we have tremendously happy shareholders. The Netflix transaction on its own reflects a more than 120% increase in the value of the company since last September. And if you look over a 2-year period, more than a 200% return to shareholders. So our shareholders are thrilled. The board is pleased. It's a great strategic fit, and it's tremendous value for our shareholders.
But might those shareholders be more thrilled if you get a sweetened offer from Paramount Skydance? If they pony up $34, would that complicate things?
If we receive a revised proposal from Paramount, we will do what we have done for months, which is we will consider it on its terms, on the merits, not based on what they say they will do or may do in the media, but what they actually are willing to commit to in a legal document.
And to that point, I mean, Mark, put yourself in the Paramount board's shoes. I mean, if you're Paramount and you've been saying for weeks now that your offer wasn't best and final, what are you waiting for? What do you think they're waiting for? What's their next move going to be?
Yeah, I think it comes down to the certainty. They have a team that's evaluating whether to raise this, but is it about price or is it about certainty? And it comes down to financing, right? You've got Netflix that has a balance sheet. They've got the cash. You have Paramount that has to structure and finance the deal. And so they're also limited by the financing markets. And again, it comes down to certainty.
And I would agree with that, by the way. I think, value and certainty are separate but entirely related. It's excellent to sign up a deal, but it's critical to close the transaction. And we have a tremendously high degree of confidence that the Netflix transaction will close.
What about regulatory certainty? I mean, we saw that Senate hearing yesterday. It feels like both sides, Andy, are coming at this. From the Democratic side, it's too big, it will create a behemoth. From the Republican side, Netflix is woke, or whatever term you want to use. Donald Trump worried about CNN. It does feel like this in particular has become a political hot button issue.
I've been doing this sort of business for a long time, and when you're playing in the big leagues like this, you have to expect that you're going to go through a public process, that people are going to stake out their points of view. We've spent a significant amount of time with Netflix working on the regulatory profile of the transaction. This is a deal that's positive for consumers in terms of choice. This is a deal that's positive for creators in terms of investment in content and theatrical release with 45-day windows. This is something that's great for the entertainment industry. It's great for jobs in America. So we do have a high degree of confidence that the transactions will clear.
And more on that regulatory point, obviously Paramount is speeding ahead trying to get its own regulatory approvals for a deal that's not yet signed. Does it matter if they get certain approvals before Netflix? Does that play into, I guess, how shareholders view it at the end of the day?
Well, as I said earlier, we're having a very great and open dialogue with our shareholders. So we think before the vote, they will well understand the full regulatory landscape. At the end of the day, you need all the approvals to close. That you might be a little bit ahead on one versus another isn't particularly relevant. I also think, as has been proven in the past, that even if Paramount gets beyond this waiting period under the HSR rules, until the deal closes, which is at least 9 to 12 months away, the DOJ has the ability, and in the past has, challenged transactions. We think Paramount knows that. We know that. And as one of their lawyers who previously worked in the government said, any well-advised client knows that the waiting period expiring does not mean your transaction has been cleared.
Mark, I'd just love to get your thoughts on this.
I was just going to say, it depends also on what happens. You've got a shareholder vote coming up. If the vote goes the wrong way, clearly the deal is not going to happen. But why would the vote go the wrong way? Only if people are worried that the certainty is evaporating because of potential big changes to the deal or a block transaction. Unclear where that's going to shake out, but if there's even a hint that the transaction could be blocked, the certainty component starts to evaporate.
But what do you make just of, I mean, like even the president himself has been involved in this deal. How does that change the contours?
I mean, the arguments are, you look at something like a YouTube or Instagram reaching billions of people. The combined HBO Max and Discovery together with Netflix is 350 million subscribers. That's our estimate. So 350 million versus over 1 billion in YouTube, Instagram, all these companies that compete. And so to the point that was made yesterday in the hearing, this is not just about streaming content. It's a much bigger universe of competition. The consumer needs to make sure that they've got choice, but the argument that Netflix is making is there's a lot of choice out there. So we'll see what happens. It's an evolving process, but certainly it's not a slam dunk. But I would certainly say, it's also not that the deal is going to fall apart either. I think what ultimately happens is maybe there's some small changes that need to be made to make sure that the regulatory environment is safe and comfortable.
And that seems to be a lot of what the discussion has focused on, is how are regulators going to define the market? Is it going to be narrow or is it going to be broad? Does streaming and your attention to streaming compete with sleep, as the argument has been made? But so just zooming out a little bit, no matter what happens here, assuming there is a deal with Netflix or Paramount, it's going to reshape the media industry. What does that mean, Mark, for those that aren't part of this? Like Comcast obviously tried to jump in here. They are on the sidelines now. What happens to them? And what happens to Paramount if they don't do this deal?
Right. I mean, this is a chess game, and everybody needs to watch where the pieces go. It's an evolving landscape, and they don't want to be left when the music stops and have no chair. So I think what has to happen is you need to look at the landscape and say, what should we be doing next? There are a ton of potential buyers who could come in here who are building media empires that would love to own some of these independent companies or companies that haven't been acquired yet.
Andy, just literally 30 seconds left. Is this just one of many more media deals to come?
Well, one of the interesting pieces of this deal is that, we'll see what the future for Discovery Global is after we do the spinoff, which will deliver value on day one, but will probably deliver substantial value in the future, depending on what comes, to your point. And the other answer to your question is yes. I mean, it's just a tremendously exciting time to be an M&A advisor in this space. There is so much going on, and it's quite creative, and it's ambitious, and it's strategic. So it's everything you want in a deal.
That I'm gonna like clip that and play it as a promo for the Deal Show and why everyone should watch and why both of you should come back. Thank you both so much for joining us. That is today's investment committee. Andy Nussbaum, co-chair of the executive committee at Wachtell, Lipton, the main legal advisor to Warner Brothers, Mark Boidman, head of media and entertainment and partner at Sullivan Partners, and of course Bloomberg Deals reporter specializing in media, Michelle Davis. Watch all of her reporting on this exact topic. Up next, we're going to talk to the global head of M&A from one of the top legal firms. They are very busy, including advising SpaceX in its combination with xAI, Sullivan and Cromwell's Melissa Sawyer. This is Deals on Bloomberg TV.
We're just about halfway through the trading day in New York. I'm Nora Melinda. Let's take a look at our midday movers. First up, Uber shares are declining after the rideshare company provided a mixed forecast that disappointed and promoted an outspoken driverless vehicle bull to be its new CFO. This all signaling deeper investment in a closely watched area of the company's business. Shares of the company are down more than 20% from its October high. Also, Boston Scientific shares are dropping for their worst day since 2010. That's after the medical device firm delivered an adjusted earnings forecast for 2026 that fell short of the average analyst estimate. Boston Scientific shares are down more than 15% so far this year. And Bitcoin tumbling to its lowest level since 2024. It has plummeted around 40% since rocketing to a record in early October. Its plunge is raising doubts that it hasn't actually acted as a safe haven during a period of heightened geopolitical uncertainty. During Treasury Secretary Scott Bessent's testimony to a House panel this morning, he said Bitcoin won't get any help from the Treasury. Those are your midday movers. I'm Nora Melinda.
This is Bloomberg Deals. I'm Danny Berger. It's time now for Premium Players, where we spotlight insiders close to the action. And action there is this week. It is a busy IPO slate ahead coming this year, including a few familiar names just this week: Bob's Discount Furniture and Once Upon a Farm. Joining us to discuss is Melissa Sawyer, global head of M&A and Sullivan and Cromwell. Melissa, thank you so much for joining. Such a pleasure to have you. And I think there's something like 8 IPOs this week, the busiest week since 2012, or in more than 4 years. Is this just like a taste of what's to come?
I think it's a taste of things to come. Everybody has so much more confidence going into 2026. I think the financing markets have stabilized a lot. I think that private equity needs to exit some of their prior investments. So everybody wants to get things going, and the IPO market is just one symptom of that.
I know a lot of what we saw to end the year, and indeed what it seems like we're going to have this year is mega IPOs. I know your company has been advising SpaceX, not on that company in particular, but what is going to be the divide? Is it the return of big IPOs, or is it the return of volume as well?
I think volume is going to be the real marker, because we've always had a few here and there, but once we see sponsors feel like they can go back into the market and exit their portfolio companies and start reusing some of that capital for new investments, I think it'll trigger an outpouring of M&A as well. So the IPO market is an early indicator of what we're going to see in the M&A market.
And you mentioned kind of one of the triggers of that. You have private equity that's been holding on to aging assets. But for corporations, what have conversations been like with CEOs? Because I say not even IPOs, but it feels like there are many more corporate actions, be it mergers, carve-outs. What's the driving force behind that?
CEO confidence is back, which is really important. But I think when you talk to CEOs, there's also a conversation to be had about CEO legacy, because the tenure of the average CEO has gotten shorter and shorter. It's now around 6 years. And we've got a lot of really incredibly talented CEOs who are nearing their retirement and wanting to do big transformational transactions. And you have a lot of boards who are looking at these fabulous CEOs and saying, how are we ever going to find somebody to replace this person? And sometimes M&A provides a solution to that succession quandary too.
Why has the tenure of CEOs shortened?
I think part of it is because of shareholder activism. Activists have really been hard on CEOs, and sometimes CEOs are the first wall to fall when an activist emerges. But it's also an incredibly hard job, and it wears people down. And, I think 6 years is a long time if you're in the firing line every day.
I mean, it certainly is, especially if you have to deal with activists. And one of the things that you've been looking at that I think is so fascinating is the rise of, what's the best way to put this? Like, activists, non-activists, of people doing activist-like action, but aren't necessarily that themselves. What's going on there?
Yeah, this is so interesting. So activism originally started in the 1980s with the corporate raiders like T. Boone Pickens and Carl Icahn. Until about 10 years ago, though, we mostly just saw activism being deployed by activist hedge funds. It was an investment strategy that they used. Now, what we're starting to see is sponsors and strategics and CEO founders using activist techniques to break up deals, to stop deals, to catalyze deals. So all of those same techniques from the 1980s are now being deployed by these individual shareholders, and it's so interesting.
It is. I mean, just coming to mind is like Chip Wilson coming back to Lululemon, a former founder. Does it also say something about the success of that type of strategy in this year, 2026, that it is being deployed now?
Yeah, I mean, I think part of it is that these CEO founders see a moment where they can have influence even beyond what the passive funds have had historically. During the Biden administration, we heard a lot about ESG. We heard a lot about the large mutual fund companies and how they were influencing companies. I think we've entered a new era where individual shareholders and active investors are going to have a more powerful influence over how companies define their future.
A lot of what we've also been hearing about helping ease the wheels of M&A is just a more friendly regulatory environment. How much more friendly is it? What are you actually seeing in Washington, D.C.? Is it an administration that is much more willing to pass through some of these deals?
Well, right now, a lot of the change is just at the level of rhetoric. But even toning down the rhetoric has helped a lot to restore confidence in companies that are considering transacting. Beyond the rhetoric, there are signs of some thawing in Washington. So notwithstanding that J.D. Vance has still articulated some concerns about mergers in tech and healthcare, we have seen that the U.S. regulators at least seem more willing to consider behavioral remedies, divestment remedies, which all allow transactions to proceed more confidently. I think the problem is the challenge that we're all facing as deal makers right now is that what's happening in the U.S. is not mirrored everywhere else in the world. And so you could end up in a scenario where you're presenting a deal to the U.S. regulators and getting a different result than you might get in Europe, for example.
That's really fascinating. But I mean, we even had yesterday a cross-border deal with a European bank coming in and buying the U.S. Do you think that's going to be a rarity, especially given this administration is more focused on internally the United States versus what's happening in, for say, continental Europe?
Yeah, again, I think this may be an area where what people say is not always mirrored in what's actually happening behind the scenes. I think certainly in areas where national security is a particular concern, cross-border transactions will be harder to get done. But there are lots of other kinds of deals, and we saw a tremendous inflow of capital into the U.S., especially from countries like Japan, where they have a lot of money to deploy, they have demographic concerns to deal with, and there has been a tremendous amount of investment in the U.S.
By the way, I remember speaking to more kind of on the junior side bankers in like 2023 who were like, we're so bored. I bet there is no one bored at your company right now.
Nobody is bored, that is for sure.
Melissa, thank you so much for joining us. We really appreciate your time today. That's Melissa Sawyer, Global Head of M&A at Sullivan and Cromwell. Coming up, we're going to take you inside the Bloomberg terminal and see where firms stand in the league deal rankings so far in 2026. You're watching Bloomberg Deals. Welcome back to Bloomberg Deals. Danny Berger here alongside Scarlett Fu. Scarlett, we are looking at one of the best functions, MA Go on the terminal.
Absolutely. So we're looking at who's leading right now, and Goldman Sachs is in a familiar position. It is number one with a 10% market share, $47 billion of deals announced, and just this week advising on Santander's bid for Webster and Texas Instruments' purchase of Silicon Labs. You look at JP Morgan, number two position, 8% market share, $36 billion of deals announced. Remember, last year, JP Morgan told its bankers that they need to work harder to catch up to Goldman Sachs. It's still early in the year, so they've got time.
Give them time,
number
Scarlett.
3 is Centerview Partners, boutique firm, 6.3% market share, $28 billion of deals announced. Only 12 deals for Centerview versus 29 for Goldman and 21 for JP Morgan. But Centerview obviously making a big splash early on in 2026.
Yeah, interesting to see the boutiques like Centerview and Perla Weinberg there. Scarlett, thank you very much. And stay up to speed even after the show. Subscribe to the Bloomberg Deals letter. That does it for the first ever episode of Bloomberg Deals. We'll be back next week, same time, same place.